morning, everyone. Welcome, and thank you for signing up for today's webinar. My name is Tom Hipsch, and I am the Director of Outsourced Solutions for CTBK, and I will be the moderator for today's session. This webinar is really the result of feedback we've received that there is no real forum or roundtable for local not-for-profits to come together and discuss topics that are affecting their organizations. We at CTBK would like to be of assistance in that area. After today's event, there will be a brief survey to ask your interest level in joining such a roundtable. Currently, what I'd like to do right now is take a quick poll of our attendees to your work status at your organization. On your screen will be a brief question. It looks like we have a good cross section of attendees, so that's going to be perfect for our session today. Before we begin, I'd like to address a few housekeeping matters. First and foremost, please help yourself to the virtual coffee and pastries located on the virtual table in the back of our virtual conference room. Second, we encourage that you to ask questions, so please use the Q&A button on the bottom of your screen to type in your question. Lastly, and most importantly, CPE credits. Each presenter will present a key word during their presentation. Please keep track of these key words as they will be required to qualify for your CPE credits. Now, I'd like to ask one more quick polling question before we get started on our webinar. We would like to know, are you expecting to get out of this session today? Perfect. I think that our session today will address all of these issues. So now it is my pleasure to introduce to you the presenters for today's event. Tim Hipsch. Tim is a manager with CTBK with a focus on nonprofit clients. He will be discussing upcoming accounting standards updates, cash flows, as well as certain KPI that not-for-profits should focus on. Next, we have Randy Glenn. Randy is a certified cyber risk manager for the Evans Insurance Agency, and he will be discussing cyber risk management and privacy liability insurance. Alyssa Gross. Alyssa is an associate attorney with William C. Moran and Associates. She focuses her practice on church and nonprofit law, including ongoing organizing new entities, assisting with application for tax-exempt status, and advising on operational issues throughout an organization's life cycle. And last but not least, Melanie Yohe. Melanie is owner of Grant Strategies LLC, specializing in global grant research writing and program evaluation for nonprofit organizations. Melanie is also a guest speaker for the State University of New York at Buffalo, Introduction to Nonprofit Business. With that said, I'd like to turn the segment over to Tim for his first session.
Thanks, Tom. As you mentioned, my name is Tim Hipsch, and I will be going over the accounting and KPI section of this webinar. So ultimately, what will we be learning today? I'll be going over two upcoming accounting standards updates regarding leases as well as in-kind donations. I'm going over the statement of cash flows and some things to look at, as well as some industry standard key performance indicators that nonprofits should look at. So the first thing we want to go over is ASU 2016-02 regarding leases. We'll be going over things that nonprofits should be focusing on in order to ensure you're going to be accounting for leases in accordance with the standard moving forward when it becomes adopted. A general overview. This ASU is requiring that all leases be capitalized on the statement of financial position, or otherwise known as the balance sheet. It's also requiring lessees to classify leases as either finance or operating to determine the applicable accounting. Now, finance leases, which were previously referred to as capital leases, the accounting for these did not change underneath this ASU, so we're not going to be focusing on those today. We're going to be focusing more on operating leases that are now going to be capitalized on the balance sheet as a right-of-use asset, as well as a corresponding operating lease liability. Underneath this lease standard or any lease agreement, there's going to be things considered to be a lease or non-lease component, which need to be identified by the lessee and the lessor in order to allocate how the payments are going to be accounted for. For example, if you're leasing a building which comes with communal parking or common areas or real estate taxes that need to be paid, there's typically not a right to control those types of things, and so they would become a non-lease component. If you are a lessor, you need to account for these non-lease components underneath ASU 2014-09, which is revenues with contracts with customers. So if you think you have a lease that has those in there and you're a lessor, I would advise sitting down with your accountants or your auditors to determine the proper accounting. The lessee, instead of breaking out those non-lease components, could use a practical expedient to include those in the lease components in order to have the accounting be a little bit easier. One other thing to look for is embedded leases. Now, these would be something that if you have a service contract with a vendor they're required to perform a service for you, if there's a specific asset that they need to use underneath that service contract, that might be considered a lease that you should look for and look at your lease agreements to see if that's applicable. Two questions that you should be going over to determine the proper accounting and to see if this is applicable to you is, first, is there an identifiable asset? Is there a physically distinct asset that your organization is going to be using underneath this lease? And secondly, is there a lease? For this physically distinct asset, is there a right to control this asset? Can you direct all the usage of it at your organization? And ultimately, are you experiencing all the benefits from the use of that asset? Now, if you've identified that there is an operating lease, underneath the standard, what would happen is you'd have a right of use asset, as I mentioned before, as well as a corresponding operating lease liability. Now, how do we value those two things? We'll start on the liability side. This is calculated as the present value of the future minimum lease payments, which we'll go over in a couple examples in a little bit. Included in that present value calculation is a discount rate. Now, there's various rates that you can use underneath this accounting standard. You can use the rate that's charged by the lessor in the lease agreement if it's known. You could use the incremental borrowing rate, which is the rate that you could obtain if you were to lease this asset from a third party, a different third party. However, all nonprofits could use the risk-free rate rather than the borrowing rate. Now, the rate that you can use, that you will ultimately use, is the rate as of the implementation date of this standard. If there was a lease that was already in place prior to the adoption of this standard, you do not need to go back and find out what the rate was at the time the lease began. You can just use the rate at the time of adoption of the standard. Now, as far as the asset side, this value is calculated as the lease liability, which was just calculated, plus any initial direct costs or prepaid lease payments, and then you would subtract out any lease incentives incurred. The asset is amortized over a straight line basis over the life of the asset, which we will also go over in a couple of examples in a bit. Now, what represents an initial direct cost? These are incremental costs of a lease that would not have been incurred if the lease was not executed. Typically costs for negotiating and arranging the lease are not included. However, if there's any costs, legal fees associated with drafting up this lease agreement, those could be considered initial direct costs. And an example of lease incentives would be any leasehold improvements made by the lessee underneath this lease. So for example, if you were leasing an office space and you did some leasehold improvements to tailor it to what you need, those could be considered lease incentives and be subtracted from the initial cost of the asset recorded. Now, what we have here is a little bit just a graph showing how leases are going to be recorded on the statement of financial position, or otherwise known as the balance sheet, as well as the statement of changes in net assets, or commonly known as the income statement. Now, as I mentioned before, the finance lease portion did not change underneath the standard. So this middle column, we're not going to really go over. I'm going to focus more on this far right column underneath the operating lease. This is where the changes really are going to be made underneath the standard. So what you'll see is on the balance sheet in that top row, you're now going to have a right of use asset as well as a lease liability, as I mentioned previously. In the income statement, the lease expense is going to be recorded straight line over the life of the lease, and there's going to be an interest portion that we'll calculate in a second, so you can kind of see the flow of the journal entries that you'll have to record. And then ultimately, you'll have a lease expense on that income statement. So the first of two examples that we want to go over is a fairly simple and straightforward example. It's a 10-year lease that payments do not change throughout the life of the lease. So what you'll see here is we have $163,000 payments over 10 years using a discount rate of 10%. Now, I don't have an Excel in front of me to show you that present value calculation or a calculator to walk you through it. So you'll have to take my word for it that if you were to do the present value calculation, it would come out to be $1 million as a debit to right of use asset and a credit to lease liability of $1 million. Now, at the end of year one, when the payment is made underneath this lease, what you'd have is a lease expense of $163,000, which is just the amortized payment made over the life. Then you would have $100,000 recorded to lease liability, which is just the $1 million balance times the 10% rate. And then the right of use asset credit, as you can see here for $63,000, is just the difference between those two. And that will continue throughout the life of the lease. It will just be the difference. Ultimately, when the payment is made underneath this lease, you would have a debit to lease liability of $163,000 and a credit to cash for the payment made. Now, at the end of year one, what you'll see is that the ending balances for the asset and the liability remain the same. This will continue on throughout the life of the lease until it ultimately is zero at the end. So you'll see underneath this fairly simple example, the asset and the liability balances will remain the same. Now let's switch to a little more complex example. This is a lease that has escalating payments. So for the first 5 years, the payments are $150,000. And then for the last 5 years, the payments go up to $175,000 roughly. It's still over 10 years, and it's still using the same exact 10% discount rate we used in the previous example. Now, although these payments increase throughout the life of the lease, the present value of these future payments still remains $1 million. Why is that the case? If you were to take the average of all of these payments made throughout the life of the lease, it would average out to be the $163,000 that we had used in the previous example. So therefore, the present value still remains the same. Now, at the end of year one, we still have that lease expense of $163,000. Now, that's different from the $150,000 that you are paying in that year one. Now, why is that? Because the lease expense is amortized straight line over the life of the lease. So it's the average of those payments made throughout the life. Then the lease liability, again, is $100,000, same as the previous example, which is the $1 million asset times the 10% discount. And then the right of use asset credit, again, is just the difference between those two. However, on the payment side, the entry that you would record is the $150,000 of the payment you actually made. So you'll see that there's a difference between the lease expense and the lease liability. What this ultimately results is a add back on the operating cash flow side. And then what you'll see on the right-hand side is at the end of year one, the balance for the asset and the liability are different due to that discrepancy between the lease expense you're recording and the actual payment being made. Now, this will continue on throughout the life of the lease, so don't worry if they continue to be different. Ultimately, at the end of the lease agreement, those balances will become in line and be zero. However, let's fast forward to year two underneath this lease. The entry again, you'll have an expense to lease, a debit to lease expense of $163,000. Now, the lease liability portion is $95,000. Where do we come up with that? That is the ending year one balance you can see here of $950,000 on the liability side times the 10% discount rate. So that becomes $95,000. And now the right of use asset credit underneath this entry has gone up slightly by $5,000 in order to account for an increase in amortization that needs to be made on the asset. Again, on the payment side, this payment entry will be a debit to lease liability of $150,000 for the payment actually made in year two, and then a credit to cash. And this entry will stay the same until year 6 when those payments increase to the $176,000. And then once again, as you can see, the right of use asset and the liability remain different and ending balances at the end of year 2, and this will remain until the end of the lease. Now, what we have here underneath the standard are some enhanced presentation on the balance sheet that need to be made for these operating leases and finance leases. So what you'll see on the left-hand side here of the table on the screen is acceptable presentation on the balance sheet. So you have right-of-use assets, operating leases of $25,000. Then you have right-of-use assets, finance leases for $900. And then on the liability side, you have operating lease liabilities and finance lease liabilities broken out separately. Now, there is another way you can present this. In the middle column, what you'll see here is you have right-of-use assets for operating leases of $25,000, and then just property, plant, and equipment of $2,000. And on the liability side, you have operating leases of $25,000 and then other liabilities of $1,800. Now, the finance lease portions are now embedded in that property, plant, and equipment and other liabilities line. So what you would need to do in the disclosure section is disclose the fact that the right-of-use assets for the finance leases are included in that property, plant, and equipment line item, or conversely, in the other liabilities line item on the liability side. As far as what's not acceptable underneath the standard, you cannot lump all right-of-use assets for operating and finance leases into one line item on the balance sheet, included as you can see here, just right-of-use assets as a generic term, and the other liabilities or lease liabilities side on the balance sheet. Now, the disclosures underneath this new standard are going to be very enhanced. They're going to need qualitative as well as quantitative aspects of them. Some items that will be qualitative are the nature of the leases, whether there are any related party leases, any separation of lease components, as well as the basis and terms on which variable lease payments are determined. Now, on the quantitative side, you would have items such as the total cost of the leases, the amount recognized in the financial statements, the discount rate used, as well as the undiscounted cash flows for the next 5 years and thereafter. Now, before we move into the in-kind donations aspect of the webinar, we're going to have a quick polling question that will come on your screen. If we can just ask you to respond to that, please.
Tim, while we're waiting for the polling question to finish, we do have a question from an attendee. Do
Yes.
leases under 12 months need to follow the new lease standards?
Fairly simple answer, no, they do not. Those leases can be expensed to the income statement as any other lease was done previously. However, on the one slide, you would see under quantitative or qualitative disclosures, any short-term lease applications for leases under 12 months should be disclosed. Okay, so we have a mix of answers here regarding in-kind donations of yes, no, and I don't know. For those saying yes, what we're going to go through are some enhanced disclosures that you should be tracking in order to be ready for when this accounting standard comes down. If you're currently not tracking in-kind donations, these will give you some information of what you should be tracking moving forward so that you're ready for this ASU. And then if you're not sure, what we'll go through is some items that might trigger to you're thinking of whether or not you do have in-kind donations and what you need to track. So a general overview, this ASU is going to be effective for fiscal years beginning after June 15th, 2021. Early adoption is permitted and it's retrospectively applied. So it'd be a good time now during 2021 to start tracking the items that we're going to be going over so that you're ready for this adoption when it comes down. It's applicable for not-for-profits who receive contributed non-financial assets, or in other words, in-kind donations. Ultimately, it just enhances the presentation and disclosures over these kinds of donations. It does not change the recognition and measurement requirements for them. Now, as I said, the presentation and disclosure enhancements are ultimately what this ASU does. On the income statement, in-kind donations need to be presented as a separate line item. And additionally, in the notes to the financial statements, these in-kind donations need to be disaggregated by type. Now, some of the things that you would need for these disclosures are qualitative information about how these in-kind donations were used, any policy about monetizing them, if there are any donor-imposed restrictions, as well as how they were valued, which market you were using to value these items. Now, which kind of gifts are in scope? These are contributions of non-financial assets, things like fixed assets, the use of fixed assets, materials and supplies, intangibles, and services. Contributed securities do not fall under the scope of this ASU, as those are typically monetized immediately and used similarly to cash. So that would not fall under this new standard. And the contributed services to your organization, the accounting treatment remains unchanged in this ASU, so we won't go over that in too much detail. Now, as I mentioned before, the new disclosure underneath this ASU is identifying which type of market you use in order to value your in-kind donations. There's two markets, a principal market and a most advantageous market. The principal market is the market with the greatest volume or level of activity for the asset or liability, whereas the most advantageous market is the market that maximizes the amount that would be received if you were to sell this asset, or minimize the amount that would be paid to transfer that liability. Now, if the market that you use in this fair value measurement is a market in which a donor has imposed a restriction for you to use it, that must be disclosed, which you'll see on the next slide when we go over a example disclosure. Now, this ASU does not prescribe how the information needs to be disclosed. It can be made using a table, a narrative, or a combination. And the example we have here on the screen is kind of a combination. You have some narrative form at the top, and then you have a table which identifies on the left-hand side the kind of in-kind contributions received. The next two columns are the value of those in-kind contributions for the last 2 years on the financial statements. Then you have the use of those in-kind contributions and the types of programs or activities they were used in, whether there were any donor-imposed restrictions, and then the fair value technique and inputs used to value those in-kind donations. And what you'll see in the pharmaceuticals row here is that the donor-imposed restrictions of use outside the US, so they have a valuation technique of the area where they were allowed to sell these, and then the area where they were not allowed to sell these. So you have that distinction between how you value them and having that proper disclosure. Now, before we move on, the CPE word for this section is gorilla. So make sure you mark this down and keep it safe for when you have to fill out your CPE form so you can get your CPE credit. The next item we're going to go over is the statement of cash flows and a general overview of how this should be looked at and the different types of ways you can report the statement of cash flows. So ultimately, the cash flow statement illustrates the actual flow of money through the organization and how much cash is available for expenses. Now, there are two types of cash flow methods, the direct and indirect. The indirect method takes the change in net assets at the end of the year and reconciles that net down to the net cash flows provided or used in operations. Whereas the direct method essentially presents cash flows by type of major sources and uses of cash. And we'll go over an example of each type of method in a couple slides. On the statement of cash flows, there are three types of activities or three sections: operating, investing, as well as financing. Operating activities are those basically cash brought in or spent during the normal operations of the organization. Investing activities are things such as purchases of fixed assets, purchase and sales of investments are the two most common that you would see in a nonprofit. And then lastly, financing activities, the majority of which you'd see in a nonprofit are the use of debt. So any proceeds received and repayments on debt would be classified as financing activities. Now, as I mentioned, there's two types of presentations of the statement of cash flows, the direct method and the indirect method. So on the left-hand side, you'll see the direct method being used, where the cash flow received from various sources, as well as the cash payments that were made to other sources, are totaled and then shown in some summation on the statement of cash flows. Whereas the indirect method, you would start with the change in net assets at the top, and then have a reconciliation of your non-cash items that are in your change in net assets, as well as the change in cash flows relating from operating activities for various balance sheet accounts. One thing I want to note is, regardless of the presentation that you do use, the direct or indirect method, your net cash used in or provided by operating activities will be the same at the end. It's just a difference in presentation. Now, before we move into key performance indicators, we have another polling question that we're going to have come up on your screen. If you can answer that quickly, please. Okay, so we have a good mix here. Some of you are using key performance indicators on a monthly basis with your board members and going over those. However, some of you are not. So what we're going to go over is some industry standard KPIs that, if you are already looking at some on a monthly basis, maybe these are ones you haven't looked at yet, or if you are not, these should give you an indicator of what you might want to be looking at on a monthly basis. So the first one we want to go over is donor retention rate. Essentially, this is the percentage of donors who give your organization 1 year and then again the following year. It's a fairly simple calculation. You would take the number of new donors you acquired in the first year and count how many of those donors gave again the second year. So we have an example here at the bottom of, in year 1, you had 100 donors. In year 2, this increased to 120, but of those 120, 50 were repeat donors from year 1. So your donor retention rate would be 50%, because you have 50 from year 2 divided by the 100 from year 1. It's a fairly simple calculation, but it just shows you how well you are at retaining those donors and keeping them from year to year. The next item would be the fundraising return on investment. This metric essentially just shows if your fundraising efforts are working year to year. It's calculated as the funds raised by the campaign less the total cost, and then divided by the total cost to see what your actual return was. So in a fairly simple example, if your campaign cost $10,000, you raised $15,000, you netted $5,000 of income from this fundraising effort. So your return on investment is 50%, sorry, which is essentially the $5,000 you made on the total fundraising campaign divided by the 10% or the $10,000 that it costs to put on that campaign. So your return on investment would be 50%. The next KPI is going to be the average gift size and donation growth rate. The average gift size is just to determine the average gift size of a gift from your donors. Fairly straightforward. How you calculate this is you would sum up all of the gifts received during a year and then divide that by the number of gifts received. Whereas the donation growth rate, you're essentially looking at the annual rate of growth in donations from year to year. And this is calculated as taking the change in donations from one year to the next, so 2020 donations minus 2019, and then divide that by the 2019 donations multiplied by 100 to get you a percentage of what your donation growth rate is from year to year. Another KPI would be cash on hand. This is telling you the number of days an organization can continue to pay its operating expenses. And a healthy non-for-profit should have a minimum of 1 month operating expenses on hand. Essentially, this is calculated as you take your total cash on hand at the end of a month or year. Then you take your total operating expenses and subtract out any non-cash expenses to determine what your cash on hand calculation is. So down here in the bottom of the example, at the end of the year, you had cash on hand of $100,000. You have total annual operating expenses of $500,000, but of that 500, 50,000 is depreciation, which is non-cash, so that needs to be removed. So essentially, your cash on hand at the end of this year would be 81 days, which is the $100,000 divided by $450,000 of net operating expenses, so net cash operating expenses times 365. Relating to accounts receivable and payable, a healthy nonprofit should not have receivables and payables past 30 days. If you do, here we have some questions that you might want to consider to determine if there's some things that you might need to change in your organization. For accounts receivable and payable, for both, is the customer paying on an installment method, or is the vendor allowing the organization to pay on an installment method? This would allow your receivables and payables to lag past 30 days because of those extended payment terms. If for accounts receivable, should the receivable be considered a doubtful account? Have you exhausted all efforts in order to collect that money? And along with management, you've decided that that ultimately is not collectible, so you would determine to write it off or reserve against it. And then lastly, for accounts payable side, are we behind due to a cash restraint? Are our payables lagging because we just don't have the cash to pay our bills? Which could be the case, but it's something to look at on a monthly basis. And then lastly, for both receivables and payables, do the payment terms that we have with the customer or vendor allow for payment beyond 30 days? So are they allowing us to pay in those 60 to 90-day terms moving forward, which would allow those payables and receivables to age past 30 days? And then lastly, what we have here is just a helpful dashboard where on the left-hand side, you have some core financial nonprofit metrics that we just went over, as well as one other one, including line of credit. In the middle, you have what a very healthy nonprofit should look like. So it gives you a metric to base where your organization stands. And then on the right-hand side, where you can put in the actuals for your organization to determine if you are in a good spot or if there's some improvement that needs to be made. And lastly, here's my information. If there's anything that I went over that you want some additional information on or have any questions, feel free to reach out. You can reach me at the email listed here, or if a phone number and you ask for my name, they can direct you to my direct line. After that, if there's any other questions, please feel free to put them into the Q&A. I'll give it a couple seconds to see if there's anything that has come through.
Hi, Tim. We have a question.
Okay.
Do we understand correctly that the in-kind donation value does not get listed on the P&L or does get listed on the P&L?
So it does get listed on the P&L. Once you've valued those in-kind donations, they would be listed as a separate line item on your income statement as in-kind donations in the revenue side. And then you would have the corresponding in-kind donations in the expense side so that they net out to zero.
And do you have some examples of in-kind goods and services?
So some in-kind services would be if let's say a newspaper is providing advertising for your organization that you do not need to pay for, that would be considered an in-kind service. An in-kind good would be the donation of, let's say, a piece of equipment that you can now use in your organization, but you did not pay for it. It was donated to you. So that would be an example of an in-kind piece of equipment or good.
Thank you.
Okay. Well, if there's no other questions with that, I'm going to turn it over to Randy Glenn with the Evans Insurance Agency, who will be covering the cyber risk management portion of our webinar. Thank you, everyone.
Thanks, Tim. Good morning, everyone. Thank you for joining us today. I hope you walk away from this with some in-depth knowledge of different things you can do in your organization to help curb against cyber exposures. We have seen an uptick in those claims within our agency, and I think we have a quick poll question just to sort of gauge the temperature of the room in terms of how many of you have experienced a ransomware attack, either personally or in your organization. So we'll give it a couple of minutes for the results to come in from that. But introducing myself, Randy Glenn, I work with the Evans Insurance Agency as a certified cyber risk manager. I started with the agency back in 2014 with a strong focus on municipal insurance. Much like not-for-profits, I realized quickly that municipal budgets just didn't account for elaborate IT controls and staffing to really curb against the exposure. So it really thrust me into this role of understanding cyber risk, how it pertains to not-for-profits, how it pertains to municipalities and fire districts, really understand the coverage forms, what was available, and how to sort of shift that risk financially to insurance. So in 2017, I obtained my cyber risk manager certification. And then in 2019, I was asked by Chubb Insurance, who's the largest insurance provider in the world, to participate in their first ever cyber designation program through Carnegie Mellon University in Pittsburgh. And through that program, it really helped me to tie in the technical piece with the financial piece. So I really gained some insight into how cyber criminals operate, the money that comes from this type of operation. And so it was really eye-opening, and it helped me to sort of understand the risk from both angles. So today I help clients large and small, not just not-for-profits. I do small business, I do large business, but we really help them wrap their heads around what their exposures are, what assets that they have in their possession that they're responsible for protecting under regulation. We do comprehensive reviews of their current insurance programs to see if they do have that coverage built in. And we also do cost analysis, so we can help you determine maybe what limits you might need or what the cost should be for the policy that you're looking at. So it's really an overall approach to cybersecurity and sort of helping you button up your organization and make sure that in the event of an incident, you can get back on your feet quickly. So in today's, so we got our poll question back. 24% have experienced a ransomware attack, 76% have not. That's good. That's a quarter of the room has been through the hell that comes with a ransomware attack, and I can assure you it is not fun. It's something that we deal with on a regular basis from a claims standpoint, helping our clients get through it. So my hat goes off to those of you who have experienced it, and you're probably going to realize in this presentation that a lot of these things you either put in place or you had in place before that breach happened. So going through our agenda, we're going to discuss the legal landscape. What does that look like? Because it has changed within the last few years. We're going to discuss incident versus a breach, understanding the difference. There is a difference, and it's important that you have that universal communication across your organization to differentiate between what is an incident and what is an actual breach. We'll talk about the threat landscape, sort of the things that we see on our end from the insurance side, from the risk management side, current trends that we see in the industry, things that are happening with remote work environments, and then we'll discuss some organizational preparedness, some things that you guys can do with your organization to either help you curb the risk or get back on your feet quickly in the event of an attack. So the legal landscape, security versus privacy. In the past, probably 4 years ago, we started to see this shift from data security, which was the protection of the data that you have in your possession. And so every state has law that says that if you're housing data, depending on what type of data it is, you are legally responsible for protecting that data. There's also federal regulations and international regulations such as GDPR. About 4 years ago, we saw a shift from the actual protection of the data that's in your possession to the collection of data. So now they're regulating the collection of that data. They want to know, why are you collecting it? What are you doing with it? How are you disclosing that you're collecting it? Who has access to it? And there's a lot of regulation now around the collection of that data. And so GDPR was really the first international regulation we saw put in place that was reaching into the United States to penalize companies and organizations for the collection of that data. So making sure that you understand the difference between the two. Most of the current regulations that we're seeing, such as the SHIELD Act, which we'll discuss, is really around data privacy and the collection of that data. So when we talk about data security, traditionally, there's always been federal statutes. Some of them you're familiar with: Graham-Leach-Bliley Act, HIPAA. All 50 states have their own breach laws that protect their residents. And it's important to understand that even if you're an organization that's housed in New York State, it doesn't matter where your business is housed, it matters where your clients reside. So if you have customers that live in other states, you have to understand how those state regulations read in order to stay in compliance. In 2005, New York State, along with California, really put in place one of the first ever information security breach notification acts. And this act, a lot of businesses didn't realize that this even existed, but it was really geared around, in the event you have a breach, here are the steps you have to take, and here's the information that qualifies as sensitive information to trigger the regulatory environment, and you have to stay within that. In 2019, most of you are aware of the SHIELD Act. That was really an add-on to the Breach Notification Act in 2005. And really what that did was it put new requirements in place that protected the collection of the data that you were housing. And it tried to really limit the amount of data that was being collected. So when we look at the Breach Notification Act of 2005, it was first comprised of Section 208 of the State Technology Law and Section 899 of General Business Law, and it applied to any person or any business in New York that owned or licensed computerized data and included private information. Now, the definition of private information under that Notification Act was very vague, but it was generally a combination of things. So it would be a username with a password, a bank account with a password, a driver's license with a date of driver's license number with a date of birth. So it was always really a combination of things. But they've really started to streamline that and do away with it. But the important thing was that breaches must be reported to the Attorney General, Department State Division of Consumer Protection, and the state police in quote unquote the most expedient time possible and without unreasonable delay. The interpretation in our industry, and any good privacy attorney will tell you, really 72 hours is about what you've got to get things going in the right direction. So you have to have that breach reported, and you have to be taking steps to mitigate it and to notify individuals that were affected parties within that 72-hour window. I just put on here so that you can see, this is the form that's available on New York State's website. On the right-hand side, you'll see the various departments that that breach really should be reported to. And I would advise that if you're going to try to get this form and maybe implement it into your incident response plan, this is not something you ever want to do on your own. You really should have a qualified privacy attorney helping you fill this out, because once you put this out there, you really can't get it back, and you want to make sure that you're in a defensible position to help you really get through that situation. So now we look at the SHIELD Act. So the SHIELD Act, as I mentioned, really builds on the 2005 Breach Notification Act in that it requires reasonable safeguards. So reasonable safeguards have to be put in place to help control and identify risks. You have to have a designated employee within your organization to implement and monitor your security program that's specific to your organization. Employee training on your best practices and procedures is required under the SHIELD Act. And then working with a qualified vendor. So if you don't have the budgetary funding to house an IT department or to have a full-time person on staff, you really need to be outsourcing that to a third party that can help you maintain proper safeguards to protect that data and monitor the collection of that data. And then you need to be able to adjust that program on the fly. And as I had mentioned, the biggest part of the SHIELD Act is that it really expanded the definition of protected private information. So whereas before we said you had to have a combination of things, now it's really information concerning a natural person. Well, define that. I mean, that could be a name, that could be an email address, that could be a physical address, a photograph, such as GDPR states. A photograph could be considered personally identifiable information. Obviously, the big ones: social security numbers, driver's licenses, account numbers, biometric information. A lot of us are using that now on our phones, retina scanners, fingerprint scanners on our computers. So there's a lot of things that you really need to be aware of that may be in your possession and that you're responsible for protecting. So now we're going to go into incident versus a breach and understanding the difference. I'll get to the questions here in a couple of minutes. Let me just get through a few more slides here. So incident versus breach, we said in the beginning, there is a difference, and you have to really make sure that that communication on an organizational level really deciphers the two. So we call an incident, it's just a general term to identify the fact that your systems or records may have been threatened, not necessarily breached. You don't know what's been taken. You really don't know what's happened at that point. So we try to call that a security incident or a privacy incident. Once you start using the B word, the breach word, that's an intentional or unintentional disclosure or release of that information to an unauthorized party. So unless you really know that that's happened, any good privacy attorney or insurance person will tell you, let's not use that term until we know exactly what has happened. Because once you use that term and you realize that, okay, wow, we really had a breach now, there's really two parties that are affected by that. There's your organization, and you're going to have financial and reputational damage that comes from that. And that could be from intellectual property that was taken. That could be loss of money or wages because of a wire fraud situation. You could lose customer data or employee data. And then property could be damaged. We see in a lot of manufacturing cases where their computers are tied to their manufacturing equipment that their property is damaged as a result of a breach. And then, of course, the regulatory fines and penalties. Now flip it over to what we call the third party, that's going to be the financial and reputational damage that your customers, vendors, employees, or any third party experiences because of that breach. Some of the three areas that we really focus on in terms of sensitive data is personally identifiable information. So that's going to be things that we talked about earlier, social security numbers, date of birth, things like that. Then you've got protected health information. A lot of not-for-profits have protected health information in their possession. And then PCI, payment card information. One of the biggest areas to understand is even though you may be outsourcing your credit card transactions, it still doesn't take you off the hook in the event of a breach. When I go into a business and I hand them my credit card, I'm not giving it to a third party to process, I'm giving it to you. And so if you choose to partner with a third party to process my data, that's really something that you have to take ownership of. So understanding that just because you're outsourcing some things doesn't mean that you're not legally liable for that. So making sure that this communication across your organization is contained, we advise that in either of these situations, whether it's a breach or an incident, you really limit the number of people that know or that discuss it until you really know what's happened and you're able to get out ahead of it, because you could let the cat out of the bag too soon, not be within the 72-hour window, and then you're going to have some issues. So we work with clients to help make sure that that message stays contained and that we're moving it along the way it should be. So what type of information is targeted? What do the goons want and how much they have? I call them goons because that's what they are. They lurk in the shadows, and they come after your business when you least expect it. Well, media files, employee records, intellectual property, financial records. They could be coming after consumer information, social security numbers, email addresses, date of birth, any protected health information. And then don't forget about your business partners information. You may have subcontractor agreements that have proprietary information in them. You may have vendor agreements. The important thing to realize here, regardless of what information is there, cyber criminals know that if this information is heavily protected under regulation, it's going to be extremely valuable to you, and you're going to want to get that information back as quickly and as without an issue as quickly as possible. So they're going to charge you whatever it takes to get that information back. So I'm going to pause right here, and I'm going to give you this session's keyword. It is frog. So write that down. You'll need that along with the others to get your CPE credit. So the threat landscape and the current trends as we see it in our world, well, here's the attack vectors. And I'll start by telling you that 90% of the claims that we see on a weekly basis stem from human error. So that is 100% true. 90% of cyber claims stem from some type of human error. And if you really think about it, some of the more common, obviously ransomware is the biggest one right now. We see a lot of ransomware attacks, but ransomware could stem from a number of things. Ransomware could be a result of a phishing email that one of your employees got 6 months ago, and they either opened a link in that email, or they visited a website, or they sent information to that individual. It could have started as that. Let that individual into your systems. They sit docile for 6 months. They collect all of the data that you have in your possession. They read all your sensitive information. They know everything that's going on communication-wise through email, and they wait for the perfect time to encrypt it, and then they hit you with a ransomware notice. So really, ransomware could stem from weak passwords. It could stem from an Internet of Things attack, meaning if your control systems for your building, your thermostat is on the internet, that could be an access point for them to get into your system. But it's important to understand that human error is typically the introduction point to a bad actor getting into your system. And so I point that out because we'll talk a little later about some things you can do to sort of help curb that. So the threat landscape, it's a big business. As long as there's malware developers and cyber criminals that are willing to implement that malware and the attacks are successful, it is going to continue to be the fastest growing, most profitable crime. Just some stats on the right-hand side that I like to point out because I think they're interesting is that ransomware is the amounts that are demanded are typically scaled to your perceived capacity to pay. What's interesting is we often see that a criminal's in your system for 6 months, sort of laying docile. They're reading your emails. If your insurance broker is sending you your cyber liability policy through email and you're storing it in a file on your computer, they have access to that and they know what your limits are. They know what your financials look like. So they have a very intimate view of your organization, and a lot of times the ransomware is based on that information. So it really takes your negotiating power away and makes it for a very uncomfortable process. The average cost of a ransomware attack is about $133,000, and that includes ransom payments, forensics, business interruption. So if you're down for any period of time and you have to get business interruption coverage through your carrier to reimburse you for that loss of income. So it's very costly, and in organizations that don't have insurance to protect from that financial piece could really have a hard time getting back on their feet. Back in March, when COVID first hit, we did see an increase of 148% in ransomware attacks. And it was really because of the shift from work networks to remote environments. 98% of the companies that pay the ransom get their data back. This is a business. This is not, they don't want a reputation of telling you they're going to give you your data back once you pay the ransom and not following through with it, with the exception of a few well-known ransomware providers. And there's blogs and people know which ones, insurance carriers and good attorneys know which ones are not following through on their demand, and that does come into play when they advise you on whether you should pay that ransom or not. In 2018, University of Maryland did a study of 50 convicted or active cyber criminals, and it found that top talented hackers take home an average of $167,000 a month. $167,000 a month. And the lower wage earners about $75,000 a month. So that really puts it in perspective for you in terms of what the size and scope is and how much money is being made in this criminal enterprise. So organizational preparedness, what are some things you can take back to your organization to really focus on to help you guys either curb the risk of privacy or data liability, or to get back on your feet quickly? Well, organizational preparedness, strengthening your frontline is probably the number one thing you can focus on. And those are pretty obvious things that you're probably already doing within your organization. Number one, I would tell you, if you don't have an incident response plan, a cyber incident response plan, develop one. Work with a qualified attorney, work with a good insurance broker that can help you get one in place and that can be a part of that team. That incident response plan, I often say, is almost like your emergency exit map that hangs on the wall that says, in case of a fire, here's where you go, here's where you are, this is what we're going to do. It's very similar to that. It really develops a plan that helps you understand, what are we going to do in the event that our systems are shut down? Who's going to be involved in that process? Did the organization buy it from the top down? Have we tested that plan to make sure that it's staying with the current trends? And do we have it readily available? I can't tell you how many times a client will have an incident response plan, but they're storing it on the device that's encrypted. And so they don't have access to that incident response plan when they need it. I would tell you to print that plan out, put it somewhere where you have access to it, have a backup so that you know, and so that everybody that's involved in that incident response team has access to it as well. Create and implement company policies. Take passwords seriously. Implement strategies for your employees to change their passwords regularly. A lot of organizations now with the remote work environments are allowing employees to have access to things like email or remote desktops from their own devices. So really making sure you're buttoning that up and you're focusing on those vulnerabilities. Social media, track and understand what your employees or your vendors or your clients are saying on social media. Email, we talked about it earlier. If somebody gets an email and they click on a link or they open up a web page, that's all it really takes. And so having training in place to help your employees understand what to look for is key. Information access, who has access to what information and when do they need it and when do they not need it? So if somebody leaves your organization, they don't need access to that information. And having administrative levels to say, only these people are going to have access to this information and these people are going to have access to this level is key. Implement training strategies. Again, 90% of your claims come from your employees' actions. So training your employees on things to look for is super important. Maintain sound network security. I put a few things in here that insurance companies right now are really looking for in order to even consider underwriting a risk. Multi-platform, multi-factor authentication. So if you're logging into email remotely, making sure that you have to use that two-factor authentication at least to verify you are who you say you are. Encrypting data when it's traveling and when it's at rest, if it's sensitive data. So if you're sending driver's licenses or date of birth or social security numbers or anything like that through email, you really should be encrypting that through a secure tunnel. And then when you're housing that data, making sure that it's safe and your level of access is limited to who has access to that. And then of course, network segregation, making sure that if somebody gets keys to the castle, they don't have access to everything. You're segregating your networks, and you're making sure that this data is here, this data is here, half of this data is here, the other half of this data is here. You really want to segregate your networks as much as possible. You're probably already doing a lot of these things, but in the past, they have not really been mandatory to get cyber insurance. They're starting to become more and more common in terms of a requirement. And then promote organizational accountability. If you're doing all the right things and you're training your employees, you really want to make sure that you're holding them accountable if they're not following the steps that you've laid out for them. Managing your third-party relationships. This one is big. So as an organization, if you're doing all of these things to protect your organization, but you're partnering with a third-party vendor that's not taking cybersecurity as seriously as you are, then you're at risk. So vendors are really an extension of your business, and you need to make sure that you're vetting your vendors as such. So performing risk assessments on your vendors, understanding who your high impact vendors are, what data they have access to, and what are they doing with that data, and how are they protecting that data to make sure that it's not compromised, because it will come back on you and your organization, and you will be legally liable for it. Create criteria. So supplier criteria means they have to have their own IT controls at a minimum. You have to have indemnification agreements in place that says, if you're negligent and you cause a breach on your systems or mine, you're legally liable for that. And without that agreement in writing, you're really not going to stand a chance to sort of shift that risk off to that vendor. And then if they have cyber insurance, asking for that additional insured status. You probably all give certificates of insurance to vendors that you work with. You should be requiring those just the same. And so we do help our clients to sort of get those agreements in place, make sure the language is good, and review the certificates when they come in. Reviewing your contracts with your vendors. This is a big one. I can tell you that a limit of liability clause is often buried in a contract, and you may not have ever seen it, but it essentially says, if I'm paying a cloud vendor $10,000 a year to house my data, the most they're legally liable to me is the cost of that contract. So if they have a breach on their systems, they're only legally liable for that $10,000. And so making sure that you can get that limit of liability clause removed, or you can adjust it to reflect the accurate value of the data that they're housing. And then manage that relationship on an ongoing basis, and monitoring it, making sure that you're keeping up with it. And once you get your vendors in place, or you've got your key vendors, and you know who has good controls, and you know who's got insurance that they can list you on, it'll be smoother moving forward, because you'll only do business with those vendors, and you're going to limit the likelihood of a breach. So the last part that we'll talk about is shifting that risk to insurance. So you can do all of those things and still have a breach, and you really want to make sure that you have the financial backing to get up quickly and continue operating. So the first party coverages that are typically built into your policy are going to be notification expenses, credit monitoring, call center services, claims counsel, forensics, crisis management. These are all things that you're going to have to do quickly. You're going to have to get the word out there that you had a breach. This is what happened. We're investigating it. Meanwhile, we're trying to stop the bleeding and make sure that it doesn't get worse. You're going to have data restoration costs to get your systems back up. You may have loss of business income, which your policy should be reimbursing you for while you're down. And then in some cases, you'll have purely a monetary loss, and that could be a wire transfer fraud. You could have a social engineering type email that comes into your organization that your employee thinks he's used to dealing with someone else, but it's really a bad actor, and they're taking information or money fraudulently. So making sure you've got that computer crime coverage built in that's going to reimburse you for that monetary loss is big. And then ransom payments. We are seeing more and more the insurance companies will pay the ransom just to get the data back and to stop the bleeding and get you back to square one, so that they can figure out what happened. As we talked about earlier, the success rate of getting your data back once you pay the ransom is rather high. Typically, I don't know how many of you have Bitcoin or access to cryptocurrency. Bitcoin is predominantly what is required in ransom attacks. And if you don't have a wallet set up or you don't have the means of purchasing it and don't know how to do it, that 72-hour window is not the time to learn that. So the insurance company will typically put a cyber attorney in place that has that set up and will get that negotiated for you quickly with the cyber criminal. The third party coverages, these are this is the liability that comes from a breach. So you may have settlements and judgments that come from you not legally protecting the data that you have in your possession or that you're collecting. You may have regulatory fines and penalties, and they could come from your credit card provider because you didn't follow the contract that's in place for your PCI. HIPAA fines, federal fines. I mean, the list goes on. These are really the third party costs that are coming into your organization, and you want to make sure that your insurance policy is able to respond and to pay for those. Electronic and social printed media is a big one. We do see a lot of defamation and copyright infringement lawsuits that come from that. So lastly, we will discuss, this is probably to me the most important part of a good cyber insurance program. Is the pre and the post breach services. So your pre-breach services are going to be things like online risk management tools. You'll get sample documents, sample policies that you can use. There's sample incident response plans that you can sort of build off of. Sometimes you can get training modules for your employees at no charge through the insurance company for phishing and malware training, ransomware protection, mobile device use training. Some carriers offer password software at no charge that you can implement to allow your customers, or your employees to save passwords and securely change those passwords. And then a lot of times there's rate discounts on things that you might do, such as penetration testing, vulnerability assessments, endpoint protection. These are all things that you should really check with your insurance company before you go out and purchase, because you may be able to get it at no charge. And then to me, the most important part is the post-breach service. So this is really the peace of mind, and I call it the hand-holding. So in the event you come in on a Monday morning and your systems are locked up, you're going to pick up the phone and you're going to call and say, Randy, I don't know what's going on, but our systems are locked up. We have a ransomware notice. And from that point forward, you're going to have an attorney that's assigned, a breach coach that's assigned to the claim, and they're going to get you going in the right direction from a regulatory standpoint. They're going to have a forensics firm that's going to come in and help you get back up and running to stop the bleeding. They're going to reach out to individuals with notifications to let them know what information was compromised and what they're doing about it. And then they're going to appoint public relations to really control the message and capture those calls and those emails when they start coming in. So it's really a situation where, aside from the monetary value of the policy, which could be $1 million or $5 million, depending on the size of your organization from a limit standpoint, it's really having that road to be able to have somebody hold your hand to get you down, to make sure that you can get back on your feet quickly. So with that, I do see a couple of questions, which I will look at now. What do you see coverage doing in the next couple of years from a pricing standpoint? Well, we kind of talked about that already in terms of what carriers are looking for. The rates are definitely increasing. However, with good controls and doing things like multi-factor authentication, you can really help keep those rates down. Organizations that I insure that are doing the right things, we do see some flat renewals coming in on pricing, but newer ventures that just don't have any of those controls in place, it is getting a little pricey in terms of coverage, but we do have access to a ton of carriers that quote cyber liability insurance, and I can certainly go out to market for you and bring multiple options to the table. How hard is it to get the coverage in place if your controls are not great? Well, again, we do see that carriers are starting to require those things, but part of my job as a broker is sort of helping you, connect you with the right people to get those controls in place so that you can be a more marketable risk and keep your costs relatively low and help spear against a potential ransomware attack. So with that, I want to thank you guys for sharing your morning with us. Here is my information. Feel free to write down my email address or give me a call. If you have any questions at all, I'm glad to help. Thank you all for being here and letting me speak on this webinar. It was great. I'm going to turn it over to Alyssa Gross, and she's really going to talk about some of the common nonprofit governance and compliance issues. Thank you guys. Take care.
All right, good morning. I'm glad that you could be with us today. I hope this has been helpful for you. My name is Alyssa Gross. I'm an associate attorney at Williams C. Moran and Associates, which is in Williamsville. I've been in private practice for 4 years. Prior to that, I spent 8 years as in-house counsel at a nonprofit. So nonprofits are my jam. My primary area of practice is nonprofit law. So establishing new organizations, helping with the process of securing tax exempt status, operational issues, governance issues, staffing issues. And I could go on and on and on about a number of the topics that we're going to talk about today. But given that we only have so much time, I sort of chose a couple of key places where I see nonprofits facing the most frequent issues and that I think are the most important to focus on. So if an organization only has so much bandwidth to focus on specific risk areas, these are the areas I think that they should be taking a look at. So just as kind of a general overview, just sort of top risks that I see in organizations: managing volunteers, employment matters, and that really kind of relates back to volunteers and how we're managing them and how we're making sure that they don't look like employees. Working with vulnerable populations. So nonprofits a lot of times exist specifically to serve vulnerable populations. And so what are we doing to make sure that we've protected those populations from, whether it's staff or other people, and how are we going about strategically serving those populations? Tax exempt status. So again, making sure that we're protecting our tax exempt status. It's quite an undertaking to get exemption in the first place, and we want to be sure that we're protecting that status. Political activities. So, to what extent are political activities permissible, and how are we managing those political activities to make sure that we're not, again, endangering our exempt status. Social media and technology issues. I'm not going to get into this today. That was really a lot of what our last speaker was talking about in terms of data security and things like that. But in terms of social media, biggest thing there is intellectual property risk. Collaborations I will be talking about today. So what does it look like to partner with other exempt organizations or for-profit organizations? What should those partnerships or those arrangements look like? And how do we, again, protect our exempt status? Board governance, I will be talking a little bit about today, and then just conflict management. So anytime you are engaging with people, there is of course going to be conflict. And so how do we engage with conflict? How do we respond to conflict? How do we address, things like complaints? Not going to be getting into that too much today, but I do think it's an area worth examining for exempt organization administrators and boards. So today I'm going to specifically be focusing on IRS compliance, board governance issues, HR issues, and then private benefit issues specifically related to joint ventures or to engaging with other organizations, whether they're for-profit or nonprofit. So in terms of IRS compliance and reporting, the IRS is transitioning to electronic filing through this year and into next year for 990s. So it's kind of going in phases. It really depends on what version of the Form 990 an organization is filing. And the Form 1023, you may be aware, has already actually transitioned to online filing. So the 1023 EZ, which is the short form application for exemption, went to online filing a number of years ago. And we've sort of grown accustomed to filing that there. The long form 1023 actually went over last year to electronic filing. And so they have had a grace period where they've transitioned those forms over, and you've been able to submit a paper form for a period of time after that transition occurs. But just be aware that 990s are going to be sort of following suit, and they will be required to be electronically filed as well. And again, those are going in phases. So that's something to be sure that you're connecting with your accounting professional on. And I would allow some extra time to be preparing those forms for filing if you're an organization that has been filing paper forms in the past. I know for me personally, I do a ton of forms 1023, anywhere from like 10 to 30 plus in a year, depending on just kind of how the year goes. And I know for me, the transition to the online form 1023 was definitely a learning curve. The form basically looks the same, the information is the same, but just kind of navigating the website and sort of navigating what that process looks like when you're doing it online is a little bit different. By way of a reminder, organizations must file some form of 990 annually. So I run into a lot of organizations where they're under that $50,000 a year threshold. Again, that's the federal threshold. So the New York State Attorney General at 25,000 is actually looking for a 990 easy, but at 50,000, the IRS is going to be looking for the longer form 990. But I run into a lot of organizations under that 50,000 a year that think that they don't need to file anything. That is not accurate. So they need to be filing that 990N. We call it the postcard because it used to be, but it's just done now online. It takes 5 minutes. There's no filing fee. You really don't need to engage counsel, honestly, to file that, but it's imperative that that gets filed. So in the event that an organization fails to file for 3 years running consecutively, their exempt status will be revoked. And unfortunately, the last couple of years, a lot of the 1023s that I've been doing, whether short form or long form, have been actually applications for reinstatement of tax exemption. And in every single case, in my experience to date, it has been for this reason. So they failed to file a Form 990. And in a lot of those cases, it was the 990N that should have been filed. And so there was some miscommunication or misunderstanding along the way that, because we are under that $50,000 threshold, we don't need to file. So again, just make sure that that's getting done every year. Reporting of unrelated business income. I actually did a whole 1-hour presentation on this a couple of weeks ago, just specifically on the changes to the Form 990T. I'm sure it was riveting and people were just really, really excited about 60 minutes of 990T talk. But the gist of that is that the schedules for the 990T, so there used to be a dozen or so schedules that were attached to that form, have largely been incorporated into the form itself. And now what we're doing is we're actually reporting multiple streams of taxable income separated out. So they're called like silo rules. So if you think of, instead of sort of dumping all of our unrelated business income into one bucket and being able to offset, the income of one with the losses of another stream, they actually have to be separated out, and they're going to be reported on separate Schedule A's this year. So that's a really important thing to make sure that you're talking with your accounting professional about. That you are, in-house, that you are doing the tracking that's necessary going forward to keep those streams separate. And then also that you're planning ahead, because routinely what some organizations have done is they've had one particular stream that was very successful, but they've been able to offset, those net assets or those net revenues with the net losses from another stream. That's not going to be permitted anymore. So they are now separated out. And there are very specific rules about, how you determine when a particular stream of income is a separate activity. A lot of organizations will think of sort of everything they do that's unrelated as kind of one big activity, and in reality, it's not. So that's a really important thing to look at. There's some really very exhaustive regulations. There's a couple hundred pages long of regulations and the final rules and things on that. So I'd encourage you, if you have unrelated business income, definitely something you want to take a look at this year. Your word for this session is chicken. So we're keeping with our animal theme. So make sure that you take a note of that. If you're going to be looking for CPE credit on that, that is me with my chicken. God rest her soul. I don't have chickens anymore, but that was Mrs. Otterbottom. So your word is chicken. All right. Next topic is board leadership governance issue.
Oh, it looks like we're having some technical difficulties. Alyssa, we can't quite hear you. Give us 1 minute.
Sorry about that. Generally meeting every other month for a really small organization is going to be sufficient. But for an organization that's up and running and it's got staff and it's got day-to-day activities, depending on what it is that it's doing, I would generally recommend meeting monthly. Certainly though, the board should be getting financials on a monthly basis. So even if the board isn't meeting monthly for some reason, they should be getting financials. Keeping minutes. This is one where I find that often organizations are in fact meeting. They're having regular board meetings. They're actually following a lot of the procedures that I would expect to see at a board meeting, but unfortunately they're not taking minutes either adequately or they're not taking minutes at all. So to some extent we can kind of document backwards if we need to, but ideally minutes are going to be taken, you know, in the meeting and then maybe cleaned up a little bit after the meeting, but they should then be distributed to the rest of the board members and approved at the next meeting. Adopting a mission statement. I think anybody that's spent any time in sort of the nonprofit sector is aware of kind of mission drift and this idea that an organization might change focus over time. Adopting a mission statement and this next point, developing a strategic plan, will help to prevent that, which again, in turn will help to protect your exempt status. I already talked about regular receipt of financials. I definitely do find that that's uncommon in organizations. So there typically tends to be one person who's kind of on top of what's going on financially, and the board is oftentimes not terribly aware of, you know, what's on the P&L, what's on the balance sheet. They're not regularly getting financials. On that same note, reviewing the annual financial statements in the Form 990. It is not sufficient for someone to email the board of directors and say, you know, hey, I have the 990 here. If you want it, you know, let me know and I'll send it to you. It does actually have to be proactively sent out to the board of directors so that they can review it and they can approve it. Recruitment and onboarding of new directors. I served on a number of boards over the last few years, and it's always interesting to me to see what the onboarding and the recruitment looks like across different organizations. But you should have some kind of standardized process by which that takes place. Think about term limits. This can go one of two ways. I have definitely seen organizations where they have really great board members and they've got term limits in place. So maybe you can serve 2 terms and then you have to rotate off for a term. Unfortunately, if you do that, you are going to lose one of your best board members. They, of course, have the opportunity to come back, but it also does give you an opportunity to sort of build in bringing on new people and some new ideas and potentially some new connections for the organization. But at the very least, there should be specific terms for the board members, and those should be tracked and they should be adhered to. Collecting conflict of interest statements annually. I generally recommend that we do this rather than on somebody's anniversary date. We just do it once a year. So at your, you know, your January meeting, whenever your annual meeting might be, you just pass them out. They're done then, and then you know that they've been taken care of for that year. Attendance policies. This is one that I don't often see. I actually don't know if I've ever served on a board that had a very specific attendance policy. And you see, I think probably most people involved in nonprofits have seen organizations where they have a board member who's sort of tangentially involved. They're, you know, they're on the letterhead or they're on the website, but they never show up to meetings and they're not engaged. You're not doing that person any favors, and you're certainly not doing the organization any favors to do that. So the board should have an attendance policy, you know, whereby you're only permitted to miss so many meetings per year. You know, even if you're calling in or Zooming in, which I know, you know, we're all just in love with the idea of Zooming into meetings at this point. You know, as long as they're participating in some way and everyone can hear one another, that can count for participation and for attendance. And then just ongoing training. You know, there's legal updates, there's financial updates, there's always things that are going on that a board is really responsible for being on top of. You know, they're not managing the day-to-day of the organization, but they are managing kind of the overarching, you know, strategy and direction of the organization. And as a result, it's really important that the board stays current on what's required of the organization. HR issues. This is another one that we could spend a week on this. I'm increasingly seeing HR related questions and HR related issues from my organizations. I think the most frequent one I've seen in the last year is, you know, we need to talk about Bob. Bob has been a great employee here for 10 years. He's always been a little quirky. We've always had to kind of work around him a little bit, but overall, you know, it's been manageable. Bob has gone off the deep end since COVID started, and we're not sure what to do with him. Or, you know, he's requesting leave, and then he wants more leave, and then he wants accommodations, and we're not sure, you know, how do we pair PFL with FMLA with COVID related leave, and, you know, the work performance is a problem and the work isn't getting done. And there's just this very big tangled mess of all kinds of issues related to HR. I will absolutely make a pitch for outsourcing HR. I work with a company here locally rather frequently, and that's who I refer all of my clients to. Very rarely are you going to find someone that you can have in-house who's going to be able to manage your HR effectively and efficiently the way that an outsourced HR company would. And I think just having that guidance, you know, it's a lot more complicated to employ people than it used to be. And it gets more and more complicated seemingly every day. So things like, you know, you have an employee that's underperforming, but they won't request an accommodation. So maybe they really need some kind of workplace accommodation. Maybe they need some leave. They're not going to ask for it. You know, how do you address that? So those are all just some really sticky HR issues that I'm consistently finding I'm running into. And again, these are very fact and circumstance specific type things. So it's a really hard one to address in sort of a workshop format. My urge for you would just be that make sure you're seeking, you know, legal counsel certainly. And again, think about outsourcing that HR support because you want to make sure that you're not running afoul of either federal or state requirements or laws in terms of how you manage your employees. And again, that's growing even more complicated as the days pass. So those are some of the things that I've run into sort of on the HR side. And unfortunately, a lot of times there isn't really a very good answer. You end up with, you know, a relationship that's gone south, you know, somebody that maybe needs to move on and it's no longer a good fit for them to be with the organization anymore. And it's always going to be very complicated to handle that. So I would definitely encourage you to engage professional assistance early on. I get a lot of HR questions that had a client called me 2 months ago. I would have been able to do some, you know, risk mitigation where by the time they call me, you know, we're kind of quite a ways down a particular road, and that's sort of what we're stuck with. So earlier is definitely better to engage assistance on HR issues. Private benefit and joint ventures questions. I am increasingly seeing that organizations are really thinking outside the box in terms of how they operate and how they bring in revenue and financial support for the organization. And this really has kind of manifested itself in two ways that I've seen. One is partnering with other organizations that are also exempt. There's a little bit less concern there, but a couple things that we need to be thinking about. The other is partnering in sort of a lowercase p partnering. So not in the legal, you know, legal partnership sense, but just sort of working together cooperatively with for-profit entities. On the exempt side, when we're working with other exempt organizations, the biggest thing there is to make sure that our activities continue to promote our own charitable interests. So we have a stated charitable mission, and we need to make sure that our resources, meaning, you know, our time, our talent, our treasure, is going towards promoting our own charitable mission. And so to the extent that we're working with other organizations, we want to make sure, again, that organization relationship it continues to promote our charitable mission. So that's really the primary consideration there. I generally recommend, you know, a memorandum of understanding, an MOU, something to that effect to sort of memorialize the relationship. And it definitely should be, you know, reviewed and considered and approved by the board as you would any other sort of long-term relationship. But that's really the primary consideration on the exempt side. On the for-profit side, there's a little bit more to consider. We have to make sure that we are not promoting for-profit entities. And that can be kind of a slippery slope. There's a lot of things that I think organizations do that, you know, to a point it's acceptable, but we don't want to sort of step over the line and start promoting corporate supporters. So by way of example, you see a lot of organizations that acknowledge, you know, corporate donors or event sponsors or things like that. That's okay, but you don't want to step over that line into promoting corporate supporters. You know, so call this one and make sure that we, call this cement company. They're the best cement company in Western New York. Make sure that you support them because they support our organization. That would probably not be acceptable. Just acknowledging that they're, a sponsor of your event, donation or something like that is fine. The other thing is when we're entering into kind of a joint venture sort of a relationship with a for-profit, we want to make sure that we're retaining control over the decision-making in the relationship. I see oftentimes where corporate entities, sometimes they mean well, sometimes maybe not so much, want to enter into relationships with nonprofit organizations, and they will often present the exempt organization with some kind of a, an MOU or a contract or some form of, engagement document where when you review it, it becomes clear that decision-making is largely going to rest with the for-profit. That is not going to be acceptable. And so exempt organizations cannot turn over control for decision-making, specifically in terms of how we're using our resources of the exempt organization to sort of promote the relationship. The other thing is you want to make sure that the for-profit is not getting any kind of compensation or benefit beyond what would just be reasonable compensation. So, if you're going to be engaging a for-profit in some kind of ongoing relationship beyond just sort of like in a vendor vendee kind of a relationship, you want to make sure that the compensation, both monetary compensation and just sort of the intangible benefit that they're going to receive, isn't anything beyond what would be reasonable given the relationship. Now, in a lot of cases, you end up finding that the for-profit is actually really kind of taking a monetary hit on the relationship, right? So they're really in it for the right reasons. They want to be supportive of the exempt organization. And so ultimately they're actually receiving, sort of less than market rate for the relationship. That would obviously be fine. One of the things that I continually harp on with my clients and really anybody who will listen is the idea of documentation. So it's really, really important, not only that we're sort of thinking through what the relationship looks like and sort of the appropriateness of the relationship, but also that we're adequately and appropriately documenting the relationship. And this again is a place where I feel like I often get engaged a little too late. So I'll have someone come to me as an organization and say, we're working on this thing with this company, and we're sort of, 6 months into it. And now we're realizing that for whatever reason, we need to sort of go backwards and document what the relationship looks like. And when I take a look at the actual relationship and what it is that we're trying to document, there's some gaps maybe in the thought process or the decision making, or there's just gaps in kind of documentation. We don't have adequate evidence that the board discussed and then approved the relationship. We don't have documentation of what the specifics of the relationship are going to be, or there are some private benefit issues that maybe they haven't thought through. And again, most of these sort of, risk management activities that we're talking about today are, we're talking about them because we want to protect our exempt status. So there's kind of two ways to lose your tax exempt status. Kind of as an oversimplification. One is failing to file your 990s and you're automatically revoked. The other one would be operating outside the bounds or outside the scope of what the IRS would deem to be charitable. So operating in a way that's inconsistent with your application for exemption, operating in a way that looks a lot more for-profit than nonprofit, things like that. And I'm thinking that in the years to come, because of what I'm seeing in terms of, organizations being a little bit more outward focused and outreach focused, and engaging other organizations and other for-profit ventures, I'm thinking that this is going to become an increasing issue. So it's again, really important to engage counsel early on in the relationship. I hate to be the Debbie Downer, and I feel like a lot of times I am when I have clients that come to me with what they think is going to be a really great idea, and I have to raise this particular issue. So the idea of the private benefit, and just sort of rethinking what that relationship is going to look like. And that does unfortunately happen. But again, it's better to know that early on than to get sort of down the road in the relationship and find out that it may be a problem for the organization. I'm going to leave this up here for a moment while I take a look at questions. This is my email address. I included this because this is the easiest way to reach me. I'm very responsive via email. And as I mentioned, I love the nonprofit stuff, which means I love getting just sort of random questions on profit issues. And if I don't know the answer, I'm always happy to look around and see what I can find for you. I do have a question here from Kevin. Hi, Kevin. Sometimes our volunteers may get a little passionate about sharing their political views publicly with our guests. So Kevin is coming from a homeless shelter. He's the director there. At what point is this just not in good taste and move toward a potential legal problem? I would tend to err on the side of caution on this particular topic. You definitely need to be doing training with your volunteers that political commentary is just not appropriate when they're doing their volunteer service. You have a little bit less control over your volunteers than you do your staff, obviously, and it's maybe a little bit less likely that your volunteers are going to be seen as sort of representing the organization from a legal standpoint. But again, I would indicate to volunteers that political conversation is just not appropriate. I think there's too many opportunities for somebody to get offended by the comments that are made or by the discussion that's had. And then even if, in the end you prevail, I think it's a long drawn out process to, try that you're in the right. It's not a good forum for sharing political ideas. So I would definitely, hesitate to have volunteers making any kind of political commentary. If there are no more questions, I'm going to turn it over at this point to Melanie Yohe. Melanie is the grant writer and owner of Grant Strategies, and she is going to be talking about grant writing and grant procurement for nonprofit organizations.
Good morning. And okay, hello everybody. This isn't working. Here we go. Come on, get out of the way. Sorry for the delay. I'm going to apologize in advance. I'm in Puerto Rico doing performing program evaluation and collecting data on clients' programs, and I didn't account for the fact that the hotel I'm staying in would have a major restoration project going on. So there may be some noise. I'm so sorry. Come on, where'd you go? Okay. There. Sorry about the delay there. Okay, I'm going to talk to you this morning about grant seeking, and this is my contact information. I'm Melanie Yohe. Grant Strategies LLC is my company. Prior to becoming a professional grant seeker, I worked in law offices for many years, and so I'm kind of a research and writing nerd, and that's why part of the reason that I love grant seeking. I'm going to start off by giving you a little information. Many nonprofit organizations rely very heavily or exclusively on fundraising to support their financial needs. 35%, the average nonprofit spends as much as 35% of their annual budget on fundraising. And fundraisers are some of the busiest people I've ever known. Part of the reason for that is there's an average donor retention rate of less than 50%. That means that your fundraisers are spending a lot of their time every year trying to recapture funding that they lost from the previous year. First-time donor attrition rates are even more abysmal than that, with 93% of your event acquired new donors disappearing the next year. That means those the new donors that come to those galas that you spend a lot of time and energy creating never give you another penny after the first year. So grant seeking can help you out with stabilizing your organization's financial needs. How many, I want to just slip in a polling question here. How many of you love grant seeking? Can we have the polling question? There we go. How many of you love grant seeking? Okay. While you're answering that question, I'm just going to explain a little bit about the fact that grant seeking, I see the vast majority of you do not enjoy grant seeking. I'm hopefully going to help you to see some of the reasons it is a challenge and educate you a little bit about how to navigate those challenges. Grant seeking, if you have ever struggled with things like paying and retaining your employees, or growing your existing programs to ideal levels, or replicating your programs that work well and scaling your initiatives, or initiating new programs, grant seeking, a strategic grant seeking plan can help stabilize your organization and create a more balanced approach to funding your organization. And help you eliminate all of these issues. Okay. A clear grant seeking strategy can help you optimize your organization, reduce the stress on your employees and volunteers, and reduce your turnover and burnout rates. It can help you to secure funding in a more, there's a lot of funding out there you may not be aware is available, and it can help you to find and secure that funding. And it can also help create peace of mind and enable your volunteers and employees to focus on changing lives and impacting communities rather than finding out where the money is going to come from. So unfortunately, though, these are typical reactions when people talk about grant seeking with nonprofit organizations. I'm going to help clarify some of the reasons for this, hopefully. First one is access to the information. Very often organizations don't believe that they have, there's any funding available out there for them, or that there's too little available, it's not worth their effort. But 90% of grant making foundations in the US don't even have websites. The issue is not availability of funds, the issue is access to information. There are a number of subscription services that professional grant seekers pay for. They can be quite expensive, but they have comprehensive and important information. I'll just give a quick example. I was working for a church that wanted to do some stained glass restoration. They didn't believe there were any funders out there who would provide funding for stained glass restoration. If you just did a quick internet search, what you found was almost nothing. But using my subscription services, I did a quick search and found more than 15,000 funders in the US who would in some way, shape, or form support restoration of stained glass. Another issue that people have is that it's time consuming, which it is. It's a big obstacle because if you're working in a nonprofit, you're already probably wearing at least 6 or 7 hats and doing 6 or 7 different jobs. In order to properly do a correct grant seeking program, you need, first of all, to find the funders, which we've already talked about, and this sifting through thousands of funders, as you might imagine, is a very time consuming process. Then you need to properly vet the funders. This is extremely important because funders have a mission too. And when you approach a funder and ask them for grant funding, what you're really asking them to do is partner with your organization. And when they provide funding, that's a vote of confidence that your organization is going to help them to accomplish their mission. They provide the funding, you provide the hands and feet and equipment and everything else that's necessary to accomplish whatever they see as their important mission. So it's really important to thoroughly vet the funders and make sure that you're compatible so that you're not wasting time and money by applying to inappropriate funders. Part of that process is looking at their 990s. carefully reading RFPs and all the information you can about the funder helps you, first of all, to determine whether or not you may be a good fit. Then look at their 990s, see what they've funded in the past, see how your programs compare to other programs that they have been willing to fund. And then do a little research into the programs themselves that they have actually funded in those organizations, and see how your organization compares with those organizations, what similarities exist, what differences there are. And that also helps you to determine how you want to position yourself when you approach that funder. It's important to prepare things like logic models. You're going to need logic models so that you can clearly articulate to the funders what it is that your mission is, how you're going to accomplish it, and what the outcomes are going to be. You'll also need organization, very detailed and thorough, complete, detailed, and transparent budgets that are easy to read for both your organization and your projects. And a professional grant seeker can help you with those. They're accustomed to presenting budgets to funders. They know what the funders want to see and how it should be presented. You also want to be very attentive to the prompts that you're responding to when you apply to a funder. It's really easy to be excited about what your organization does and have certain aspects of it that you're anxious and to share with the funder, but you have to be cognizant of what the funder is asking and be sure that you're responding to that prompt rather than just telling them what you want them to know, because your organization may be a perfect fit, but if you give them the wrong information, they won't realize that and you won't get the funding. Too competitive. This is another obstacle, and that's a fact. It's very competitive, but part of the perception of the competitiveness is because of lack of access to the information. The other part of it is that it is actually very competitive. And so it's extremely helpful to have a professional who's accustomed to dealing with funders and knows how to approach them, how to work with them on your side to help you be successful. Okay, this is your CPE word for this portion of the presentation today. It's orchestra, and that's because an orchestra is the organization that I'm in Puerto Rico doing program evaluation with today. Okay, now, so you are thinking about taking a whack at grant seeking. Before you begin, you need to prepare. There's a lot of preparation before you start to just dive into grant seeking. The first thing is that your entity formation has to be in place, and you should have your EIN, which of course most of you probably are already there. Another important piece is your IRS determination letter. If you do not have your nonprofit tax status, you are severely limiting the amount of grant funding that you're going to be going to be eligible for. In fact, I would say there's very little available for for-profit organizations, and it's really kind of an important first step. You should also, this is not something that you should attempt on your own. I highly recommend a professional, seeking professional guidance. The forms seem simple, but it would be regrettable to have your status delayed because of something you may have missed. It's just easier to make sure that you've got a professional on top of this who knows what they're doing and can breeze you through the process without any hitches. Another thing to have in place before you begin grant seeking is professionally prepared financials. There are 3 different levels of financials that you can have prepared. The first is compiled, and it's not of any use whatsoever when you're grant seeking. You need to at least have reviewed financials prepared by a CPA Reviewed financials will be useful to you if you are a smaller organization, typically with a budget of less than $250,000 a year, and if you're seeking small grant amounts. If your organization is larger than an annual budget of $250,000 a year, and you want to pursue larger grant amounts, you're going to need to have audited financials prepared by a CPA. For federal funding, you're also going to need a DUNS number, which is a unique 9-digit identifier you apply for through Duns and Bradstreet. It's essentially proof of who you are before a federal funder will even give you access to an application. They're going to vet your organization and be sure that you are what you say you are, and that they're potentially interested in funding you. Another thing that you're going to need if you're applying for federal funding is your SAM registration. That's the System for Award Management. And again, you won't be able to access a federal application without this registration. And this is just the system that they use if you are ultimately awarded funding. This is the system that they use for requesting payment of the funding and for your reporting back to the funder on the usage. Okay. And if your organization, if your programs are operated outside the US, you may also require a CAGE or an NCAGE registration. These are, the CAGE is Commercial and Government Entity Code. NCAGE is NATO Commercial and Government Entity Code. These again are identifiers for entities located outside the US, and they are required. Any entity that does business with the US government is required to have this registration. And when you are seeking grants from the US government, you are considered to be doing business with them. Again, it's the concept of a partnership. You're not just asking for money, you're partnering with, in this case, the US government to accomplish their goal. Okay. You will also need another thing that you'll need, and I was happy to hear Alyssa mention this, is your clearly articulated board approved mission statement that you use consistently. Mission statement is not something that should be adapted to a particular funding application. It should be a consistently used and board approved. And if you shift your mission, that is the time to revise your mission statement. But your mission statement should be written in stone, and you should always ensure that what you're doing complies with your mission statement and that the funders that you're seeking funding from are have compatible missions with your mission statement. Other things that you need to have in place before you begin the grant seeking process are, first, you should be sure that you've done a needs assessment. You need to know what problem your program is going to address, who's going to benefit from the program, what the symptoms of the problem are, and what the root causes of the problem are. And it's really important to make that distinction because funders are going to ask those questions. They want to know that you have a clear understanding of what the problems you're addressing, what the causes of the problems you're addressing are, and that your programs are going to properly address the causes. You will also want to have logic models in place, and those are going to guide they're really going to be important in guiding your the process of creating your proposal or your grant application. You need to look carefully at what resources are available to you. You need to have a clear understanding of what your goals and objectives are, a clear vision of your expected outcomes, and your desired impacts. And it's important to understand the distinctions between goals and objectives, outcomes, and desired impacts. A goal or objective would be, for example, the organization is going to feed 5,000 hungry families. That's a goal. Or an activity is another word for a goal or objective. An outcome would be 20,000 children were, hunger was alleviated for 20,000 children by the program. And an impact, that is a measurable long-term systemic change that addresses the underlying problem. So it's important to have a real grasp of the difference between those and how your program addresses each of them and how to articulate that. Also, program evaluation, you need to have a program evaluation plan in place. Data or it didn't happen. I tell my my clients that all the time. You need to have a plan for measuring outcomes. You need to know how you're going to determine success of your organization. You need to be able to, you need to know how you're going to evaluate the effectiveness of your programs, and you need to be able to articulate that to funders. You need to be able to articulate that to funders before you apply for the funding, because that is also typically a question on grant applications. Tell us about your evaluation program. How are you going to do this? And also you need to make sure that the evaluation program you have in place is an ethical evaluation program. You have to, I know we've had another segment on privacy issues. You need to protect the privacy of your, of the populations your programs are serving. And you also need to make sure that the data that you're providing is accurate and just be really sensitive to the fact that the data that you're presenting to your board and your constituents and your funders is accurately representing what's happening and the impact that it's having. And finally, you're going to need to report to funders and stakeholders. What's important about this is it's not just telling them how you use their money. This is your opportunity to really build a relationship with a funder. If they love what you did and they love the impact that you had, it's the basis for an ongoing relationship where maybe they gave you $10,000 this year, but they really loved what you did with it. So next year they're going to give you $25,000. So it's important to kind of shift your perspective on what a funder is. Again, you're asking them to partner in your mission, and they are looking at your organization as the mechanism for accomplishing their mission. Okay, so why would you hire a professional grant seeker? I'm just going to recap here. You'll have access to a greater number of funding opportunities. You'll have increased grant seeking success rate, and the cost of paying a professional grant seeker is far less than paying a staff member to invest their time and talents in grant seeking. Your staff and volunteers will spend less time fundraising and more time changing lives and impacting communities. You'll reduce staff and volunteer attrition rates and stress, and you will be in a better position to build lasting relationships with funders. And that's it for me today. Does anybody have any questions?
It doesn't look like there's any questions coming in, Melanie, but thank you so much for your presentation.
You're welcome.
We do have a question about your contact info, which I know was on the first slide. So we'll get that information out to all the participants as well.
Click back there for you. So it's up there. Oh, there we go. And if anybody comes up with any questions later, please just reach out to me. I'm happy to answer anything.
Thank you, Melanie. I'm going to bring Tom back in to close this out.
Well, this concludes our section for today. We'd like to thank everyone for participating, and a special thanks goes out to all of our presenters for a very job well done. We hope that you found the materials presented to be both informative and beneficial. Please check your emails for a brief survey as we welcome your feedback, and also your CPE questionnaire. We also would like to encourage all of our attendees that if you have any questions specific to your organization, please reach out to our presenters, as they've indicated they're more than willing to help you out for any questions or issues you may have. With that said, I want to thank everybody and have a great rest of the day.